A few days ago, I was asking myself if I was missing some potential extra returns by ignoring factor ETFs, as I'm only investing in the plain MSCI World for a few years now. So today we're going to find out with data. Today we're diving into an interesting comparison between the regular MSCI World ETF and its several factor ETFs like value, momentum, minimum volatility, small cap, and quality. We'll analyze their performance, risk, and key metrics to see if these smart strategies have actually been worth it. We're going to use Python to fetch data, see some numbers, and visualize the results. Then break down those financial metrics and see what they mean to you as an investor. We're going to use Jupyter Notebook instead of a regular IDE because it's an interactive environment that lets us write the code, see the output instantly, and even embed our charts and explanations, so all in one place basically. It's perfect for walk you through this type of analysis step by step. Last but not least, this video will make it easy to understand those topics, even if you're a beginner or just curious about ETFs and portfolio performance. Obviously, what I'm going to say today is not to be intended as a financial advice, so let's dive into the code. Here we are in Jupyter Notebook, and first of all, I'm importing some essential Python libraries. YFinance to get historical price data of the ETFs, Pandas and Numpy to data handling and calculations, Matplotlib and Seaborn for making our charts. Then I define a dictionary with the ETFs we'll be looking at, all from iShares, and covering a period from 2018 to 2025, basically last week, the 28th of June. And I've set this specific start date because that's when our newest ETF, the value one, has been launched. And we want to ensure a fair comparison across all the ETFs. Each ETF has its ticker symbol, its name, the total expense ratio, which is basically the annual fee charged by the fund, and a color for plotting we'll be using later. We also defined a risk-free rate of 2%. Think of this as the return on a very safe investment like government bonds. This helps us compare return against a safe benchmark like government bonds. That's how we calculate the Sharpe ratio later. And we set trading days to 252, which is the average number of trading days in a year. We are gonna need this later to calculate volatility and to analyze our returns. Next, we use YFinance to download the close prices of each ETF from the start date to the end date. We then rename the column using our ETF names, and then we clean the data by dropping any missing values. So if I print this data, print data, okay, this is what our raw data looks like, just a simple table of daily closing prices for each ETFs. Now it comes the fun part. Here is where we calculate some key performance metrics. First, we calculate the daily returns with the method percentage change. Then we calculate the cumulative returns. These show us the overall compounded growth. If you start with $1,000, it tells you how much that $1,000 would have grown over time. The first real indicator we calculate is the compound annual growth rate, or CAGR, which tells us the average yearly return. I think it's the most accurate way to measure how much your money actually grew over multiple years because it considers the power of compounding. We adjust the CAGR by subtracting fees to get net returns. Then we calculate annualized volatility. This is our primary measure of risk. It tells us how much an ETF's price has gone up and down on average over a year. Higher volatility means obviously higher risk. We get the standard deviation of daily returns and analyze it by multiplying by the square root of our trading days. Then we have the Sharpe ratio. The Sharpe ratio is a crucial metric for evaluating risk-adjusted returns. Basically, it's useful to help answer the question, how much extra return did I get for each unit of risk I took? We calculate it by taking the ETF compound annual growth rate, subtracting our risk-free rate, and then dividing by the analyzed volatility. A higher Sharpe ratio is always better because it means that you're getting more return for the risk you're taking, so it's good. Here we calculated both the Sharpe ratio and the Sharpe ratio after fees just to see the real impact of those expenses. The next metric is the drawdown. It tells you just what the largest percentage drop the ETF experienced. It's the worst possible loss you could have suffered if you sold at the absolute bottom. It gives you like a sense of potential pain, let's say that. The last metric is the Calmar ratio. Is similar to the Sharpe ratio, is another measure of risk-adjusted return, but it uses maximum drawdown instead of volatility. Higher here means better risk-adjusted performance. All of these calculations are then organized in these results Pandas data frame. I've also sorted it by the CAGR after fees, so we can immediately see which ETFs perform best. Now, let's print results. Okay, and here we have our data frame for each ETF. We have the CAGR, CAGR after fees, annualized volatility, Sharpe ratio after fees, maximum drawdown, Calmar ratio, and the TIR. Now, numbers in a table are great, but graphs really bring this story to life. So let's plot some of them. Okay, in the first graph, we're going to see the growth of $1,000 invested. Immediately you can see that the winners here are the MSCI World Momentum with the green line, the plain MSCI World, the blue line, and the quality one with the purple line, with a significant difference from the other ETFs. Let's see this better with the second chart. This bar chart reflects what we just seen above. Look at the MSCI World Momentum leading the table, followed by the MSCI World and the MSCI World Quality. The MSCI World Small Cap and the Value one have significantly shorter bars, showing they delivered much lower growth during this period. Maximum drawdown. Again, this one shows the biggest percentage drop you would have experienced. The minimum volatility, the red one, protected the capital the best, having the smallest drawdown during the period. Small cap, the brown one, had the deepest loss with over 40%, which is a significant heart attack. Next, let's look at the risk-adjusted return. This is often the most important chart for investors. It tells us how much return you got for the risk you took. Higher is obviously better here. Here we can see the benchmark is basically on top of the table, even though we see momentum had higher absolute returns. The broad market was more efficient at generating those returns, considering its volatility. This is very interesting, actually. Our last chart is the Calmar ratio, is another measure of risk-adjusted return, at this time focusing on the worst-case drawdown instead of volatility. Here, the MSCI World Momentum actually takes the lead, meaning its strong returns allow to recover more efficient from its drawdowns. So let's jump into conclusions. So after all this data and all these graphs, is investing in a factor ETF instead of the classic MSCI World really worth it? In terms of absolute returns, the MSCI World Momentum is a clear winner, outperforming the broad market. If you were chasing to the highest return, it delivered. Does that mean that you have to switch everything to momentum? Obviously not. For risk-adjusted efficiency, the broad MSCI World itself proved to be the most efficient investment, delivering the best returns for the level of volatility taken. If you're looking at something less volatile, the MSCI World Minimum Volatility did exactly what it promised. Less risk, but also less reward. Unfortunately, the MSCI World Small Cap and the Value one are behind across all the metrics, providing lower returns, and in the case of the small cap, also higher risk. A special mention about the quality one, because it consistently delivered strong returns while also maintaining excellent risk-adjusted performance, very close to the broad market. This suggests it's a solid contender to me. That being said, at the end of the day, I personally don't think the difference between the regular MSCI World and the factor ETFs are big enough to matter, at least for me, but who knows, I might change my mind in the future. If you enjoyed this deep dive into finance and Python, please hit the like button and subscribe to the channel for more tech and finance content. Thanks for watching and see you in the next one.